Hello and welcome into the KE Report. I'm your host, Chad Markwitz, and we're getting an update today from Erik Wetterling, also known as the Hedgeless Horseman. And we'll put a link to the Hedgeless Horseman website down below this so you can follow along with Erik's work. And Erik, it's always great having you on the show just to get an update on how you're looking at the markets. And we've spent some time before starting recording today just chatting about the low sentiment in the sector and how it's difficult for junior companies to get financed, but then noticed that there are companies that are still moving forward, and a lot of them have a strategic partner or some kind of an alliance with either a large producer or a manufacturer, or at least have a key cornerstone investor to help them get access to capital and keep work going on their projects. And so I just think it's an interesting topic to look at, isolating some of the companies that actually have these strategic partnerships. And you actually track this on your website with your third-party validated portfolio so people can follow along with some of the companies you've got picked out there. But we were rattling off a lot of them in a big discussion. I'll just name drop a couple here to get the conversation going. We were mentioning recently that Agnico Eagle, the second largest gold company, just partnered with Nordic in their Scandinavian assets. You've got exploration companies funded by majors like Headwater Gold, partnered with Newmont, and Inflection Resources, partnered with AngloGold Ashanti, where the majors are funding the exploration efforts because they don't want to do the exploration, but they're happy to fund the juniors that are. BHP doing something similar with Brixton at their Thorn project for the copper. You see B2 Gold having a position in Snowline Gold even after they made the discovery to keep pressing the bet with the drill bits. I mean, there's a lot of companies we could mention, but I guess let's just start it off there with how you're looking at names in the space that actually have this strategic partnership and what advantages that gives them. How does that distinguish them from companies trying to go it alone?
Yeah, I mean, if you really want to make it as easy for yourself as possible, and I would say probably the most profitable as well, is that you simply screen for, okay, who is smarter than me or anybody else on Twitter or the forums basically, that's invested in a story, because by definition, and you can reverse engineer what you think the kind of potential scale is that they need to see. If you have a $50 billion market cap involved, I mean, what's going to move the needle for them? A $1 billion project? No, I don't think so. 2 billion, getting close, probably 3 billion and plus. And then you can look at whatever the market cap of said juniors are priced at. And obviously, if you have a huge discrepancy versus potential, again, not alluded to by you or anybody else in the retail space, but a major company. It's like, if you say, oh, this junior has $1 billion potential, nobody can call you a pumper, because that's basically what a big miner is saying when they're investing in any junior, because that's the only thing they care about. The bigger they are, the bigger the price needs to be. So it's like they have done all the due diligence. And I've heard, anecdotes like these guys do huge amount of due diligence before they enter a JV or fund a company, whatever. They look through everything. So it's like, it's not a guarantee that you're going to make a lot of money in a junior just because you have Newmont, Barrick, and all of those guys. It's not a guarantee, but you know that there's been a lot of due diligence done. And most importantly, they care about the geological potential and the potential to have a big valuable mine. And most of the value is created in the tier 2 and tier 1 deposits. That's just how it is. There's no shortage of tier 3 deposits and stuff like that, or projects with tier 3 or tier 4 potential. But then you won't see these big names in it. So it's like, if you only had a portfolio made up of names where there's either some of the smartest actual investors in the space, Lundins, McEwen, perhaps, Ross Beatty, the Frank Oostras, and or the best of the best in terms of mining companies. Like, by definition, you cannot pretty much make a mistake, especially if the sector is cheap. If a typical 3 million ounce deposit was trading at 500 million, then we're talking, okay, how much upside is there really? And these guys might be coming in and you don't see huge potential, or there's, let's say, some of the early stage explorers that in the good times run up to 500 million just based on potential. Yes, now we're talking like there's huge risk there. But now when, stuff is selling for sub 100 million, even if they have some margin of safety already, some ounces in the ground, or 50 million, or an early stage explorer with a 20 million market cap, attracting one of these big boys. You don't know what the chance of success is. You just know that these guys are saying, if it's a big mining company, they are saying they believe there's billion-dollar potential here. And of course, you don't need many of them to work out in order to actually, pay for a crap ton of juniors that didn't pan out. But I think a lot of people are a bit lazy on that department, and they just buy whatever stuff they feel like or something with no third-party validation, maybe, a serially unsuccessful CEO or something like that. And they just, have their fingers crossed, like, hey, if silver hits $100, I'm going to be good. If gold hits $5,000, I just think that's just a waste of lane. It's so easy to actually almost foolproof your portfolio pretty quickly. It's like if you were in the tech space, if you just picked companies where it's like, oh, a seed investor is Nvidia, Microsoft, Alphabet, and whatever. It's like they're saying there's potential here. They're smarter than you.
Well, and just to that point, like foolproofing your portfolio, it's not that there's no risk. It's just that they've spent so much time and money to already vet these projects, whether it's one of those billionaire investors that has a lot of history in the sector and connections, or whether it's a major mining company, or whether it's a manufacturer coming in. They've done a lot of due diligence, way more than most people have probably done before they hit the buy button in their own portfolio. But it also speaks to having a partner that can continue to help them raise capital over time. And it also speaks to, in the case of a major mining company being involved, the natural suitor for the project, or maybe there's multiple suitors if they have multiple partners. But you can see that these projects actually are garnering attention and actually can move forward. You brought up the Lundin family. I think that's a good one to use. You think about what the stocks look like before and after them getting positioned in a lot of the copper plays in Chile, whether it's NGX or Filo, but then also what they've done recently with Fireweed Metals, Montage Gold, getting involved in Faraday Copper. When they get involved, they bring not only the capital access, but also mine building experience, information. They usually bring people in that they put on the board. So maybe just speak to how when a group like that moves in, it changes the risk factor, but it also, even though the stock gets more expensive, it also gives you more confidence that it's actually a project that's going to work.
Right. I mean, for us, let's say retail, and especially the smaller you are, I might buy something today and I could sell it tomorrow if I change my mind or I find something better or something like that. For big guys like the Lundin Group, they're primarily investors. That's their mindset. How am I as an investor going to make money on this? And they don't really have an exit strategy except a buyout down the line. So you can just imagine how much due diligence they have to do, how much long-term, let's say, planning or like envisioning they have to do, because they kind of have to see that there's going to be an exit at the end of the line. Not that everyone is for sure going to end up that way, but like look at their hit rate. It's way above normal. So like they're probably the best kind of due diligence you can have, because again, they're in the same boat as the shareholder. And that's why they have a lot of loyal, let's say, followers, supporters, especially here in Sweden, that even if they have a high risk project, for example, like they used to have in, oil drilling and stuff, if that doesn't work, their flagship project, they go out and find another one, because again, they're also still investors and they want to take care of other shareholders, because that's going to benefit them, the brand name, let's say, easier access to capital and all that. They're going to find ways, or they're going to try to find ways to make it a success down the line. It might take a few years or whatever, but it's like, that's not the same for a large mining company. They might like a story, see the potential, give them money, and let's say they test the thesis. The thesis doesn't play out, so there's not going to be a $1 billion project there. They have no responsibility, and frankly, they don't care about their $8 million investment, let's say. That's nothing to BHP or Newmont or whoever. So they have no obligation or are not going to feel the need to make a success out of this when the actual flagship project didn't turn out well. And I would also say, there are some juniors out there that I like, for example, that have, free carried interest or earnings with major miners. Because right now I would say that, let's say it costs, I'm just making up a number here, but let's say it costs $50 to find an ounce of gold. And it costs $20-25 to buy an ounce of gold. So now it's like, obviously you would rather buy ounces that are already proven than it pay $50 to find the same ounces, for example. But then if you have someone else backing you, especially if it's an earn-in deal with kind of a free carried, let's say, with no limit, because there are some cases out there. I know, Inflection, for example. I think Ridgeline has the same thing with Barrick, where it's like, okay, to get to 75, they need to produce this, like carry to production or carry to a PFS. Even if there's inflation raging around the world, that doesn't matter because it's not even a fixed price. So if there is inflation and making all the sunk cost, margin of safety, the proven success go up in value, making it clearly the cost more expensive to drill stuff. If you have deals like that, it doesn't really matter because it's based on, milestones, not exact capital spend. Because let's face it, if there's an earning for 10 million and it costs 10 million to drill a hole, they could just finance one hole, basically. That wouldn't make a lot of sense. But if they're funded to, let's say, a PFS, even if it costs $1 billion, for example, in a super high inflationary environment, then it would cost $1 billion to get, 75%. Obviously, they would buy it out probably before that. But it's just, I think, again, it's an interesting situation right now where there's no real retail interest. It's hard to attract money, but still the big boys, especially the gold miners, they are making money and they want to keep making money. So they need more mines. So they're going to keep funding and doing deals and all of that. So there's going to be access to capital in those at least. And thankfully, they also tend to be the one where all the due diligence you kind of need has already been done by people that are smarter than you.
Well, let me just follow up on this idea of, the exploration side of the business getting funded by the majors. So something like the Headwater and Inflection, or you brought up Ridgeline there. I guess you could throw Brixton in that same camp with BHP being there. But there's kind of these stage gate payments they make, or there's different points where they would free carry the project up to a certain economic study. Even some prospect generators have some bigger partners like this that are going to keep funding the project and doing the heavy lifting. Now, some investors, Erik, will turn their nose up and say, I want to have 100% of it. Some management teams would say the same thing. I want 100% of it. But 100% of zero, because you can't fund the drilling for this year and you can't do any work this year, is not really a payoff. I understand the desire to have 100% of the project as long as one can. And there's some investors that want to chase management teams that have 100% of their project. But the problem is it's so darn expensive and it takes multiple drill seasons to get anything done. And then it takes even more money to do economic studies and development work. Are people better off paying the premium to have the partner with the deeper pockets that could keep pushing it forward versus trying to pick the glory hole, and having like this amazing discovery with a 100% owned project? Or should you have a balance of both?
That's a very good point. That's a very good subject. And that's one I've been pondering and probably should ponder even more. Because the funny thing is that, as you say, at face value, you hear it's like, we get 100% of whatever project. Okay, that sounds great. And then you hear about another story. It's like, at the end of the day, they would have 25%. So you're thinking, wow, it's going to be 4 times more valuable if they keep it 100%. But that's not what happens in reality. Look at some drill intensive stories that are 100% owned, for example. They might need to raise hundreds of millions to prove up something that is substantial. So that's going to be placements upon placements upon placements upon placements. So from where you started off, maybe you have, I'm just guessing here, 60% of the exposure of what you had when the story began. So in that case, it would be more like 25% if you're free carried versus 60 if you had 100%, accounting for the dilution of actually proving up the 100% owned stuff. And obviously, the harder it is to finance, the worse the terms are, the worse the market is, the longer the sentiment is depressed, that dilution factor is going higher. So the opportunity cost to a JV, especially with a funded JV, free carrying and stuff, that's actually going down the longer this sector sucks and the longer retail and other people are not interested. So it's like, in a sense, it's much more that goes into it. And I think they are, again, if you just look at the circumstance right now, if the sector started trucking higher tomorrow, that would be a completely different story. And obviously it depends on the kind of drill target and all that. There are stories where it's like, I mean, take the best one could be like, a Snowline. After 30 holes, they have something huge already. Even though, yes, it's remote and all that, it took time to actually prove it up. But not every story is like that. Some systems are more drill intensive. Maybe it's a nuggety system. Maybe it's the system is deep. That just means more dollars have to be raised to prove up an X amount of ounces. Whereas like if you're free carried, again, the opportunity cost of having free carried interest up to a certain point goes lower the more capital intensive it is to actually have the junior prove it up themselves. So in reality, it's not 25% versus 100%. It might be 25% versus 80%, maybe 60%, maybe 50%. I mean, Osisko Mining has drilled 2 million meters, for example. So, I mean, I don't know how much that costs, but it's like you get an idea. It's like, and that's why this is, I mean, as always, it's an art, not a science. But it's like that's one thing I think to ponder, especially when you involve, like, again, lack of access to capital right now. Maybe also that a lot of the discoveries are being done at depth, which is costlier to drill. You need more holes to find it. You need more geophysics and all that, and inflation to boot, which rises up the value of the sunk cost, for example. So there's a lot of stuff at play here that is, again, for the, let's say, perfectionist, is something to really take into account. At the end of the day, I don't think, again, you can't be a perfectionist. It's a grail you will never find, I was going to say. But still, it's interesting if you just really like the theory crafting of stuff. Like, okay, what's the actual risk reward in practice? Like, what is the estimated dilution, instead of just saying, oh, they only get 25, whereas these guys have 100%, and you think, oh, that means that stock is going to be 4 times as valuable if they find the same stuff. That's not true, typically.
Well, it really comes down to there's always going to be dilution, and you have to swallow whichever pill that you want as an investor. Do you want equity dilution upon equity dilution, or do you want project dilution? And that can happen through a royalty sale in the project, or that can happen by bringing in a strategic. There's times where taking the project dilution and having a partner is a far more solid footing than just doing endless equity financings and diluting down the equity position to the point where it's an insolvent company. So there's definitely a lot of considerations. And even Snowline, to your point, even after having success, they still have B2 Gold as the strategic in there. So there's another group, though, that are kind of making strategic alliances with manufacturers for the offtake agreement. Or I'm thinking of, there's also companies that just have partnerships for how they would do toll milling. Like we've talked about Magna Mining before, and how they have relationships with both Vale and Glencore in Sudbury, but they also have Dundee in there as a strategic shareholder. Or Stillwater has Glencore as a strategic shareholder now, and Glencore is interested in both cases for the smelting and the metals processing and metal sales side of the business. So what about companies like that are doing partnerships with either manufacturers or mining companies because of the value of their ore, and there's already companies looking ahead to pulling that out of the ground economically?
Yeah, I mean, with let's say royalty companies, the larger ones, I mean, how does a royalty company earn money? Well, from production. So they obviously need to see that there's a chance for production, not just theoretical good deposit that's never going to get built for whatever reason. They're thinking of the end game immediately. They're not, drill hole speculators. They can't, flip the royalty that easily. So no, I mean, that's also a good point. I mean, to have Dundee and Magna Mining, for example, they recently exercised their warrants, before they run out. But it's like, they're shareholders. They're big shareholders. I think they own like 19% or something. They obviously want the store to be a success, so they have more at risk, especially in absolute terms, than anyone else out of us. And they have deeper pockets than anyone else as well. So it's like you have those kind of, I mean, almost, kind of like a Lundin type investors. Like they want, as shareholders, the story to succeed. So they're going to help the story, provide them with money if they need to, early exercise the warrants if it helps the story and stuff like that. All of that stuff adds up over time. Most of the time, less dilution, let's say. And of course, with Stillwater, again, it's like, Glencore are called the smartest big boy around, basically. So if they see potential, and especially since they're, very much in the metals trading and smelting business and all that. Again, it's like they care about stuff that's actually going to come out of the ground one day and be worth something. And again, they seem to be very forward looking. So, I mean, they're not oblivious to the fact that, for example, the US has one operating nickel mine right now, and the Stillwater has a huge package. So that says it all, I was going to say. Again, it's like they're saying that there's billion-dollar potential. And in the Dundee case, they are smart investors, and they're actively helping out the stories. Like, that's really the stuff you want to see. But that doesn't go for 98% of juniors. It's like there's 2,600 juniors out there, whatever. I don't know how many have major backing from a major mining company, but if you just remove all the ones that don't, again, that's one way to actually make it quite easy on yourself. And I don't mean it's like, some major company invested 3 years ago and have not done anything since. That's not really fresh vote of confidence. But if you can get into some stores, alongside the Lundins or alongside some major miners, it's like almost by definition, it's impossible that you're making a mistake, because nobody, not even the major miners, know what's going to be found, but they are the best to evaluate if something big can be found.
Yeah, and I think you make an interesting point about an active strategic stakeholder versus one that's maybe been in there for years and not exercised any recent financings. They haven't taken part in them, or they haven't done any new partnerships, or they're not doing anything active. Because there are some companies that have legacy stakeholdings from the majors, but it's because of some other company they acquired a long time ago, or maybe the company did something 5 to 10 years ago and still has a stake in it, but isn't actively pursuing it, versus one that's pressing their bets. So, for example, one that comes to mind is Dolly Varden has Hecla as a neighbor at their project, at their Kitsault Valley project, but they also have Hecla stepping up and going from 10% to 15% stake in the company, which is a nice signal to see. And then they put somebody on the board of Dolly Varden. So they have a Hecla person in there. That's a company that's involved and active. And so you could see a natural suitor in a takeover. And there's other companies we could mention. But when you see a major pressing their bet inside of a company, going from maybe 5% to 10%, or going from 9.9 to 19% in a company, then you're seeing an active partner. Maybe just speak to how that's another signal to watch for.
Yeah, absolutely. I mean, that's common sense, because as you're saying, I see that in some presentations now and then, a junior kind of highlights, AK brags about, we have backing from major whatever. And then you look at their stake and it's like, well, that's not much. And then you actually, do a Google search, like, when did this company actually invest, for example? And again, it could be like 3 years, or they got into it from a spin out, or they, again, as you said, acquired some company. That's not really fresh vote of confidence. I mean, that more suggests that, okay, we don't see, I mean, if they stop kind of supporting the story, especially if it goes for, I was going to say a long time, a long gap, then what they're basically suggesting is, the thesis we saw, it doesn't appear that that's working out. But there could be differences, like in a bear market where all the exploration budgets gets withdrawn or whatever. That's not typically what we see here. So there's always like exceptions to the rule, but you do want to see that stuff. And as you said, with Hecla, for example, I mean, it's pretty obvious. I mean, if I own 5% of a company or 10% of a company, they do a raise, I increase my ownership to 15%. What does that mean? I like it even more now. It could be that there's more potential, or it's just more de-risk. Depends on the investor, obviously. Depends on, what kind of a mining company there is. But typically, if it's a mining company, I mean, probably have to do with the de-risking or the thesis playing out. But again, that's some common sense thing. It's like you want fresh vote of confidence. If the Lundins, for example, I bring them up a lot because they have probably the best hit rate out there. If they invest today at price X, and you can pay around price X, I mean, that's kind of as good as it gets, because again, they are the foremost actual investors in the space. But anytime you can get alongside of some fresh vote of confidence by a major, they're saying at that point, this potential is live, or whatever potential they see, or this project is worth something, yada, yada, yada. And of course, the longer that goes away from the recent vote of confidence, the more that diminishes, let's say. So you can't just, this big company bought into this story 3-4 years ago. So that's why I'm going to buy it today. Whereas like, yeah, but again, it might be a totally different company. They might not touch this case now with a 10-foot pole. You can't say that, or you can't know, but that's what it kind of looks like. So it's got to be fresh or relatively fresh. And then you can kind of see, just, follow the news. Is this playing out or not? So that's what I would say, because in case of a success story, if a company starts at 50 million market cap and a company that needs a $2 billion project is in there, you can just, obviously there's a lot of upside if this plays out, but that still requires probably 3-4 years of holding for it to play out. So it's not like, 6 months later and you throw your hands up. It's like, it's not a $2 billion company yet. I mean, everything takes time. I mean, the big 10 baggers, for example, they typically take a few years at least.
Well, Erik, we'll keep following along with a lot of these different companies that have these strategic partnerships, whether it be a large mining company, a manufacturer, or just a cornerstone investor that's taking a stake. It sure helps out in an environment where capital markets are very tough, if not non-existent for many of the junior companies. And it really separates the wheat from the chaff as far as the due diligence process having already been vetted by some of the biggest minds in the industry. A lot more power to get into the data rooms and to get behind the scenes than we have as individual investors. So it's an interesting area to highlight, and I'm sure that there'll be other examples we can highlight in the future as far as junior companies partnering with senior companies, and hopefully it leads to a couple of M&A deals in the sector to get the animal spirits going. But if people like getting Erik's thoughts and want to hear more about some of the companies he's following and some of the companies that he's talking to, definitely click on the link below. This interview takes you over to thehedgelesshorseman.com. And Erik, always a pleasure to have you on the KE Report.
Thanks, Chad. The same. And as always, consider me biased with any particular story I talk about.